Welcome everybody to the Lunchtime Live from Dubai again today. Hope it's all nice and warm where you are. I've just been watching the cricket. See England get beat by India, but still all looking beautiful back home. So just waiting for everybody to join us. So this will probably be a little bit longer than normal. Cash flows, as you know, is a huge topic. It's useful for SBR students. It's made for FR students, though. Takes into account all the IFRS 18 changes. So, yeah, shall we begin? So, let me make myself a little bit smaller. Here we go, then. So, cash flow statements. Now, cash flow statements are split up still into three categories: operating, investing, and financing. So this is what we call the indirect method. Now, the indirect method, basically the idea is you get to cash indirectly, and it's only for the operating activities bit that indirect means anything. So here we start off with profit, and then we take out the cash, and that will leave us with cash indirectly. And you only do that for the operating activities bit. So you start off with operating profit. Make sure you start off with that. Don't read textbooks or whatever telling you to start with profit before tax. That has now changed to operating profits, IFRS 18. Then you add back depreciation, amortization, impairment. Why? Because they're not cash. So we're starting with a not cash figure, profit. We're adding back all the not cash stuff. So we'll be left with cash indirectly, hence the indirect method. Inventories isn't cash. Receivables isn't cash, it's receivable. Payable isn't cash, it's payable, not paid. Okay, so you put all those in, and then you'll get to your cash flow from operating activities before income tax. So guess what comes next? You're right, income tax, and the income tax paid. And then you've got your final figure then, net cash from operating activities. So that's the first of the three parts of a cash flow statement. There's operating activities. Next, we'll look at investing activities. Investing activities is basically anything to do with non-current assets. But this time we put the cash straight in, not put the profit and add back or anything. We go for the cash straight in. Now, for some reason, this system isn't picking up that first line. I noticed this before. But what that should say is purchase of PPE. If you buy PPE, it goes in there. If you sell PPE, it goes in there. So cash flow from cash flow from investing activities, is all to do with the buying and selling of non-current assets, such as intangible assets. Could be the sale of intangible assets. It could also be, and this is the big IFRS 18 change, interest received always goes in here, and dividends received always goes in here. I say always 99% of the time. Okay, so interest received and dividends received go to investing activities. Remember that always. So there's your investing activities pro forma. So we've done operating, we've done investing. The final one is financing. Okay, and how you finance your business, either by issuing shares or by issuing a loan. And it could be paying back shares or paying back a loan. So again, we have a problem with the first line. That should say the issuing of shares, the money coming from issuing shares. Then it could be the money coming from issuing a loan, getting a loan, or it could be the paying off of a loan, which would be negative cash flow, or it could be paying off the capital part of the lease. And this time, interest paid and dividends paid go to financing activities. Where do interest received and dividends received go? Investing activities. Interest paid and dividends paid, financing activities. Okay, then you're done. Now you've done all three sections. Once you've done all three sections, you add them all up together, and that will give you your net increase or decrease in cash. You take that net increase, you add it on to the cash that you had at the beginning, and then you'll have the cash at the end, and you're done. Okay, so that's how cash flow statements look. That's how IFRS 18 has changed them. What I thought I'd do, because you're all very nice, giving up your lunch times, I'll do a little question with you. Okay, so there's our cash flow from operating activities. I just wanted to add in a couple more, or one more, I think, two more that could exist. That's a key one. A gain or loss on disposal of a non-current asset goes to operating activity. You might think, shouldn't that go to investing? No, it should go to operating, because the idea is you've made a gain or loss on the sale of an operating asset, an asset that you use in your operations. Any increase or decrease in provisions would go in there as well. Okay, I promised you a question. There's your question. Can you remember, what do you start with now? All your old textbooks will say profit before tax. The actual answer is operating profit now, according to IFRS 18. So you start off your cash flow statement with operating profit in operating activities. Now we add back all the non-cash things. And it's all the non-cash things above operating profit. You're saying to yourself, is there any non-cash in there? And I can see one immediately above operating profit, depreciation. So depreciation we need to add back. And a little tip, if you're adding something back, you're basically getting rid of it. So if you're getting rid of an expense, that's good news, isn't it? So that's why it's a positive. Okay, if you're getting rid of a profit, that's bad news. That would be a negative. So it's a bit weird, but it kind of makes sense. Okay, so then you say to yourself, is there anything else non-cash? No. So, well, not that we know of anyway. So now we think to ourselves, right, let's have a look at the inventories, receivables and payables. Now, I said to you, we're adjusting for everything above operating profit that's not cash. Well, where's receivables, payables and inventory here? Well, receivables is debit receivables, credit revenue. Inventory is debit cost of sales, credit inventory, and payables is debit cost of sales, credit payables. So the receivables, payables and inventory are effectively in there, and they're all non-cash. Okay, so I've given you just some extracts from a balance sheet. And the extracts from the balance sheet says inventory, if you look on the right-hand side is X4, the left-hand side is X5. So do you agree with me that inventory has gone up by 10? Yeah. So it's gone up by 10, and that's what you put in your cash flow statement. You say increase in inventories, 10. Now, the way I want you to remember this, you only have to remember inventories really, and people are always quite happy with understanding that if you've got more inventories, you've had less cash. Agreed? So that's why it's a negative. So as long as you know that, you can kind of work out the rest, because inventories is an asset, receivables is an asset, so it worked the same way. Payables is a liability, so it worked the opposite way. Anyway, inventory's gone up by 10. Receivables has gone from 90 to 70. Receivables has gone down by 20. So you put decrease in receivables, and it's gone down by, was it 20? So it's going to be a positive, isn't it? Because increase in inventories was a negative. That's an asset. So decrease in trade receivables should be the opposite. And it is 20. So that's one way of thinking about it. Another way of thinking about it is trade receivables are people who haven't paid you money. So if they've got smaller, that means they have paid you money. Hence, it's a positive 20. Up to you how you remember. Now we look for payables. Payables has gone from 40 to 55, an increase in 15. So you think, right, I'll put an increase in trade payables of 15. Then you think, flipping heck, which way round is it? Well, your increase in inventories was a negative, and that's an asset. So your increase in payables will be a positive because it's a liability. Or, logically, the idea is payables are people you haven't yet paid. So if they've increased, that's more you haven't paid. So that's more positive cash flow. Okay, all still with me? These are all the kind of simple marks that you get. You'd have passed the cash flow question, and you'd be high-fiving your students on the way out of the exam hall so far. Okay, So that's all that. Then he tells us PPE cost 40, and he tells us the accumulated depreciation was 20. What was the net book value is my question to you. If it cost us 40 and the depreciation on it was 20, the net book value was 40 minus 20, 20. And we sold it during the year for 25. So we sold it for 5 more than the net book value. Way, we've made a gain on the disposal of a non-current asset. Where do we put that? Profit on disposal of non-current assets. It was a gain, and remember I said to you, when it's a gain, you're adding back, you're getting rid of it, so that's bad news here, so you take it away. And that's how you deal with that. So remember to start with operating profit, add back depreciation, profit or loss or disposal of non-current assets, deal with that. Deal with the working capital, the inventory, the receivables, the payables. Get the signs the right way round. There was no increase in provisions in this question, and everybody is happy. Okay, well, hopefully you're all happy. I appreciate it's hard, but let's keep going, hey? Okay, so there's the cash flow from investing activities. That first one, as I say, that first heading for some reason hasn't come out. But anyway, that was purchase of PPE. So we're looking for any of these. And just a reminder, interest received, dividends received, investing activities. Interest paid, dividends paid, financing activities. Anyway, let's go back. It was sold for 25,000. What was the cash flow? Not a trick question. It was sold for 25,000. What was the cash flow? 25,000. Is that cash in or cash out? If we sold an asset for 25,000, it's cash in. And that's all we do with here. We just put the cash straight in here for investing and financing. This adding back nonsense is only for the indirect method of the operating. Investing and finance, you just put the cash straight in. So proceeds from sale of PPE, 25. Thank you very much. Okay. Anything else in there? Says interest was paid in cash. So we think, interest. Let me go and have a look at what the interest charge was. Interest received, 5. Okay. So interest received, that's what goes to investing activities, isn't it? Interest received, positive 5. What could be easier? And I think that's everything. So what I'm going to do now with you is what you'll probably have to do in the exam, and that's do a PPE account. So that net book value of 220 is from X4. So X4, it cost 300 and the accumulated depreciation was 80. So at the start of our year, the net book value was 220. Do you all see that? The 300 minus the 80, so net book value is 220. At the end of the year, the net book value is also 220. Coincidence, that's all. 320 minus 100, okay, in 2005. And then you just put in here everything that's happened. Can you remember there was some, we sold the asset and I've got rid of the net book value. That's the key. You don't put in what you sold it for here, because this is the PPE net book value account. So you put your disposal in of negative 20, because that was the net book value of what we disposed of. Remember, we had depreciation, so we need to take into account the depreciation, negative 30, and that's it. That's all that's happened. So if your net book value was 220 to start with, then you sold something with a net book value of 20, then your net book value should be 200, but then you depreciated it by 30, so your net book value should be 170. But your net book value at the end is 220. So how have we gone from 170 to 220? We must have purchased some, okay? So that's how you calculate the purchase. You put everything you know in, then the balancing figure is your purchase. And I'm presuming that this 50 was purchased with cash. So that's that top line there, the 50. Sorry about that. I don't know why it didn't come out, but it should say purchase of PPE 50 at the top there. Okay. So that's it. Just get rid of everything else. There wasn't any sale of intangible assets. There wasn't any dividends received. And you are done. Which leaves us with one section left, which is cash flow from financing activities. And as usual, there's a missing line. That should be the proceeds from issuing shares. Then we've got the proceeds from issuing a loan, the repayment of a loan, repayment of a lease, interest paid. I seem to remember we've got that. Dividends paid. I think we've got that. And then we're done. Okay, so let's go have a look. So dividends paid, yeah, 60,000. So dividends paid, you just think, right, okay, examiner tells me dividends paid. I know that goes to financing activities. Where does dividends received go? Investing activities. Where does interest received go? Investing activities. Where does interest paid go? Financing activities. And there's interest paid, look, 15. So I can put that straight in, 15. And I think I'm done as far as that's concerned. So there was no issuing of shares or long-term borrowings. There was no lease. So that's that. I'm done. And then what I'd like you to do is, in the exam this is, go back now and have a look and think, well, have I missed anything? Yes, you have. You've missed income tax. So, income tax. Now, income tax, what was the opening balance? Just make sure you get the years right, because this is an extract from the SFP. Your opening balance was 2004, which was 9. Your closing balance was 2005, which was 12. Now, if you had deferred tax as well, just add the deferred tax balance onto the normal income tax balance. That's all you do. So if deferred tax was 30 opening, your opening here would be 39. That's all you do. Simple as that. So you've got opening, you've got closing, and then income tax is also on the income statement. So let's go back and have a look at the income statement. I'm looking for income tax expense. There it is. Income tax expense of 40. So you put that in. So if you owed the taxman 9, and then during the year you owe the taxman an extra 40, surely your tax payable should be 49. But look here, it's only 12. What must have happened? You think you owed him 49, you only owe him 12. You must have paid 37. Okay, so it's a balancing figure again. So income tax payable 37. Can you remember where that is? You have to go all the way back to the start of this little lecture, and if you went all the way back, you'll see it's actually there in the operating activities right at the bottom. Income tax paid 37. Okay, that is everything that I wanted to show you. Thank you all for your time. I just want to recap now a few things with you. So remember, operating activities, as it says there, operating profit you start off with, add back depreciation, amortization and impairment. Also add back any gain or loss on sale of assets. Increase in your or decrease in your working capital, your inventories, trade receivables, payables. Make sure you know the signs. All you really have to know is the inventories one and know that that's an asset. So if you know the increase in inventories is a negative because you've got less cash, then you know an increase in trade receivables is a negative because that's an asset. And you know increase in trade payables is a positive because that's a liability. So it's the opposite. Okay, and then income tax goes there. The final things I want to remind you about are interest and dividends. Where does interest received and dividends received go? Investing activities. Where does interest paid and dividends paid go? Financing activities. That's pretty much true, you know, in 95% of the cases. Okay, I hope you found it useful. Hope you enjoy it, and I hope to see you at aCOWtancy.com, particularly after the exams. I wish you well for the exams. We will be doing another lunchtime live on Monday, and I might do a which paper to do next sort of thing, because I know that you find that useful. So thank you ever so much again. All the very best, and have a lovely rest of the day. Thank you.